You probably used it today, maybe without even thinking about it. You tapped your phone, swiped a card, sent money to a friend, paid a bill online. Digital payments are just, well, everywhere.
And most of the time, they just work seamlessly, almost invisible, really.
Exactly. It feels invisible. But what's really happening under the surface? Who are these massive engines making all this global money movement possible? And how do they actually pull it off?
Yeah, it's far more than just that tap or the swipe we see. It's this incredibly complex, interconnected global system built on layers of technology and partnerships.
Right. And to really get it, sometimes you have to dig into the nuts and bolts,
Mm.
which is why we're doing a deep dive today. We're looking at a specific set of documents a listener sent over, excerpts from the Visa Form 10K annual report, their fiscal year 2024.
Yeah, this is our chance to sort of peel back the curtain on one of the biggest players out there, see what makes them tick, what challenges they're up against, and where they might be heading.
So our mission here is basically to pull out the key insights from this filing. We want to unpack their core business, look at the numbers, how they performed, understand how they create value for shareholders.
And also, critically, examine the risks and challenges they talk about pretty openly. We want you to come away feeling like you've got a much better handle on this giant of global commerce.
Okay, let's jump right in then. At its heart, what is Visa's stated purpose, according to this report? How do they say they achieve it?
Well, their stated purpose is pretty grand: to uplift everyone everywhere by being the best way to pay and be paid. Fundamentally, they're about enabling global commerce and money movement,
And the core of that has always been connecting.
connecting four key players: you, the consumer, the merchant you're buying from, the bank that issued your card, your issuer, and the bank that serves the merchant, the acquirer. They provide that network to move money securely between them.
Right, that classic four-party model. Right? I think most people are familiar with that. But the report makes it really clear that the payment world is getting a lot busier, more complex.
Oh, absolutely. That four-party model is still the foundation, but the ecosystem around it has just exploded. You've now got digital-only banks, tons of different digital wallet providers, fintech companies popping up everywhere, building new services.
Even governments using these rails, right?
Exactly. Governments, NGOs using these networks for things like benefit disbursements. So yeah, Visa's had to evolve way beyond just connecting those original four players.
And they talk about this vision, this strategy they call being a network of networks. Sounds ambitious. What's the idea there?
It is ambitious. Essentially, they don't just want to be their network connecting consumers and businesses for purchases. They aim to be the single connection point for, well, any type of money movement across any available network, not just their own card rails.
Okay, so going beyond that typical swipe or tap at the store.
Way beyond. They're actively pushing into facilitating payments between P2P, Businesses sending money to consumers, that's B2C. Businesses paying other businesses, B2B. And even governments paying citizens, G2C. It's much broader.
Okay, this is where it gets really interesting for me, because that leads right into what they flag as a key growth engine, their new flows business. Why is that such a big deal for them?
Because the potential market size is just enormous. The report points to something like a $200 trillion annual opportunity in payments that happen outside of that traditional consumer-to-business lane.
200 trillion. Wow.
Yeah. So think about all the B2B payments, cross-border remittances, government payouts, insurance claims, all that stuff. Visa sees this huge landscape as, well, ripe for digitization. And these new flows initiatives are explicitly designed to grab a slice of that pie.
So how are they actually going after that massive $200 trillion opportunity? What are the main prongs?
Two big areas they highlighted are Visa Commercial Solutions and Visa Direct. Commercial Solutions is all about helping businesses and governments streamline how they handle payments. Think employee expenses, managing accounts payable, complex cross-border B2B payments, stuff like that.
And is that gaining traction?
Oh, yeah. It's already at a significant scale. They processed, get this, $1.7 trillion in payments volume just through their commercial products in fiscal 2024.
$1.7 trillion.
Yeah.
Just on the commercial side.
Okay.
And Visa Direct. The name kind of implies sending money directly.
Exactly. Visa Direct is focused on enabling faster money movement, often in real time, both domestically and internationally. It lets funds be sent not just to Visa cards, but also directly into bank accounts or digital wallets around the world.
How many places can they reach with that?
They say they can now reach over 11 billion endpoints globally.
Hmm.
Cards, accounts, wallets, it's a huge reach. And they saw nearly 10 billion transactions flow through Visa Direct in fiscal 2024. It's really critical for enabling those P2P, B2C, G2C new flows we talked about.
Okay, none of this happens without some serious tech muscle behind it all.
Not a chance. The report really emphasizes VisaNet, their core global processing network. That's the brain and the nervous system routing and settling transactions worldwide 24/7.
And they're investing heavily there.
Constantly. They talk about significant ongoing investment in their whole tech infrastructure, software, hardware, data centers, telecom networks, and, as you expect, cybersecurity is absolutely critical. They describe a pretty comprehensive approach using advanced tech, including AI, to protect the network and all that data.
It also sounds like a huge part of enabling these new services, reaching all those endpoints, involves teaming up with other companies,
Yeah.
especially fintechs.
Yes, definitely. The report actually calls fintechs a vital growth engine. It seems Visa has really shifted towards a more open partnership approach. They see fintechs not just as potential competitors, but as key collaborators who can build innovative new payment experiences using Visa's network and infrastructure.
Do they give any sense of how fast that partnership side is growing?
They do. In fiscal 2024, they apparently added over 650 new commercial partnerships globally just with fintechs. That's up 30% from the year before. So it shows how quickly that collaboration is ramping up, helping them get into new segments and deploy those new flows.
They also mentioned finishing the Pismo acquisition early in 2024. What did that add to their toolkit?
Right, Pismo. It's a cloud-native platform for banking and issuer processing. So buying them basically expands Visa's ability to offer modern, flexible core banking and card issuing services, especially helpful for, say, digital banks or fintechs that want those cloud-based solutions. It also helps them better support emerging payment types and real-time payment networks.
Okay, so let's recap the strategy bit. Leverage the core network, obviously. Expand aggressively into these new flows, commercial direct money movement. Power it all with tech, and crucially, partner heavily with fintechs. How did all that actually play out in the financials for fiscal 2024?
Well, looking at the top line, the revenue growth looks pretty strong and consistent. Their GAAP net revenue, that's the standard accounting measure, climbed from around $29 billion in fiscal 22 up to nearly $36 billion in fiscal 24.
And the most recent year-over-year jump.
From 23 to 24, it was a solid 10% increase. $32.7 billion to $35.9 billion.
Nice. What were the main things pushing that revenue up?
They point to three main drivers. The biggest boost came from growth in what they call nominal cross-border volume, basically. People using Visa cards more when traveling or buying internationally. Excluding intra-Europe stuff, that was up 14% in 24.
Okay, cross-border is key. What else?
Processed transactions, just the sheer number of payments hitting VisaNet, grew by 10%. And the overall nominal payments volume, the total dollar value of all transactions, that increased by 7%.
Did currency fluctuations play a big role? Sometimes that can muddy the waters.
Apparently not significantly this past year. The report specifically notes that exchange rates weren't a material factor in the FY24 revenue growth. So those volume and transaction increases seem to be the real story.
And you can see how their main revenue lines connect to that, right? Service fees track payment volume, data processing tracks transaction counts.
And international transaction revenue tracks that cross-border volume. Exactly. It lines up.
So revenue's up nicely. What about the bottom line? Profitability.
Profitability also showed really robust growth. GAAP net income, the standard profit measure, went from $15 billion in FY22 up to $19.7 billion in FY24.
And for investors, the earnings per share, the EPS.
That followed suit. GAAP diluted EPS increased quite a bit, from $7 in FY22 to $9.73 in FY24. Strong growth there, too.
Now, they also provide non-GAAP numbers. Can you just quickly remind us why companies do that?
Sure. Companies often use non-GAAP figures alongside the standard GAAP ones. The idea is to give investors what they see as a clearer picture of the ongoing operational performance. They do this by excluding certain items they consider non-recurring or maybe non-cash or related to specific past events like acquisitions.
Like acquisition integration costs or big legal settlements?
Exactly. For Visa, it might be things like gains or losses on investments, the amortization of intangible assets from companies they bought, or maybe significant one-time litigation charges. Stuff they argue doesn't reflect the core day-to-day business performance.
Got it. So looking at those non-GAAP figures, what story do they tell?
Well, the trend is identical strong growth. The numbers are just slightly higher because of those exclusions. Non-GAAP net income rose from $16 billion in FY22 to $20.4 billion in FY24, and non-GAAP diluted EPS went from $7.50 to $10.05 over that same period.
So whichever way you slice it, GAAP or non-GAAP, the picture is one of a financially healthy company with growing profits.
That seems fair to say based on these numbers, yeah.
But costs went up too, right? Operating expenses grew. What was behind that increase in 2024?
They did. On that non-GAAP basis, operating expenses were up 11%. The report points mainly to higher personnel costs. They hired more people, increased compensation, reflects investments in growth areas, and also integrating acquisitions like Pismo.
Makes sense. What else?
Marketing spend was up quite a bit. They mentioned major campaigns and big sponsorships like the Olympics. General and administrative costs rose too, things like travel benefits, a large charitable contribution, higher lease costs, and then smaller increases from professional fees and depreciation amortization. Basically, the costs associated with growing and managing a more complex global business.
Okay, shifting gears slightly. What about their financial position overall? The balance sheet? Anything stand out?
Well, they do need significant debt outstanding, around $21.1 billion in principal as of the end of September 2024. That's a fair bit of leverage.
Important context. And the auditors.
The auditors, KPMG, gave them a clean bill of health, a standard unqualified opinion on the financial statements, and also confirmed their internal controls over financial reporting were effective. That's always important for investor confidence.
And thinking about cash flow, where was cash going, besides just running the business?
Well, beyond the cash generated from operations, they used quite a lot on client incentives, those long-term deals they strike with banks or big merchants to lock in Visa volume. That's a significant cash use.
And acquisitions, too, like Pismo.
Right. They spent cash on acquisitions, specifically calling out the $929 million for Pismo in January 2024.
Okay, so we've got this picture. Powerful business, expanding into new markets, strong financials driven by growth in volumes and transactions, profits climbing. How does this all translate into creating value for the actual shareholders, the owners of the company?
Well, a very direct way is simply returning capital to them. The report really highlights a substantial share repurchase program.
Buying back their own stock.
Exactly. In fiscal 2024 alone, they spent $17.0 billion buying back 64 million shares of their Class A common stock on the open market. That's a huge amount.
And they're not done.
Nope. As of the end of September 24, they still had another $13.1 billion authorized for future buybacks. Doing this reduces the number of shares out there, which helps boost metrics like earnings per share.
But then the report gets into these really complex-sounding things called retrospective responsibility plans for the U.S. and Europe. How on earth do those factor into shareholder value? It sounds counterintuitive.
Yeah, this is definitely one of the more unique and frankly complicated aspects of Visa's structure. It goes back to how they were originally formed through consolidating various regional entities and then acquiring Visa Europe later.
Okay.
These plans were basically set up years ago to handle potential liabilities from before all that restructuring happened, particularly related to ongoing litigation, like those big merchant interchange lawsuits.
So it's about managing old legal risks.
Primarily, yes. But the mechanism is interesting. It involves specific classes of shares like Class B and Class C common stock or Series B and C preferred stock that are mostly held by the original member banks.
And how does that help current Class A shareholders, the ones most people trade?
Okay, here's the clever if complex part. When Visa either puts money into the U.S. plan's escrow account or recovers certain losses related to the Europe acquisition, it triggers adjustments to the conversion rates of those other share classes.
Meaning?
Meaning it adjusts how many Class A common shares those B, C, or preferred shares can eventually convert into. When those conversion rates are adjusted downwards, it means fewer potential Class A shares will hit the market in the future when those conversions happen.
Ah, okay, so fewer potential shares down the road. Less dilution.
Precisely. And the report explicitly states this reduction in the potential future share count has the same economic effect on earnings per share as repurchasing the company's Class A common stock.
Wow, so it's like a buyback, but achieved through these complex legal and share structure adjustments related to old liabilities.
That's a good way to think about it. It effectively makes their earnings power behind each existing Class A share more valuable because there's less threat of future dilution from these legacy share classes converting. It's a unique way to handle old baggage while boosting current EPS potential.
That is intricate. Did they give a recent example of this in action?
They did. They mentioned that in July 2024, related to the Europe Plan's annual assessment, they effectively released $2.7 billion of value tied to some of the preferred stock. This involved some technical share issuance, but the key outcome, they highlighted, was reducing the potential number of Class A shares that could be issued from converting that preferred stock, a benefit to current Class A shareholders.
Okay, so summing up so far, dominant business, strong financials, actively returning cash via buybacks, and using these unique structural things to manage legacy issues and boost EPS. Sounds like they're pretty much sitting on top of the world.
You'd think so, right? But the 10K also dedicates a lot of space to risks and challenges. They're certainly not pretending it's all smooth sailing.
And what are the big ones? What are the major headwinds they're flagging?
I'd say the single biggest recurring theme reading through those sections is the complex and evolving global regulatory landscape. That phrase, or variations of it, comes up again and again.
Regulation. What specific kinds are causing them headaches?
It's really broad, and it's global. They face pressure and new rules popping up all over regarding interchange fees, the fees merchants pay banks when you use a card. Also, rules about how transactions can be routed, sometimes mandates forcing the use of domestic networks instead of Visa or MasterCard.
Data rules, too, I imagine.
Huge. Data privacy laws, data localization requirements, meaning where data absolutely has to be stored within a country. Cybersecurity standards are getting tougher everywhere, plus complex licensing rules just to operate in various countries. It's a minefield.
And it sounds like it's not just isolated rules, but a bigger trend.
Yeah, the report suggests it's part of a broader movement. Countries and entire regions are seeking more control, more sovereignty over the payment systems operating within their borders.
Can you give some specific examples of where they're feeling this regional pressure?
Sure. The EU is pushing for operational separation between card schemes like Visa and the processing businesses. Central banks in big markets like Brazil, India, the UK, Canada, they're all increasing their oversight. Canada, for instance, actually designated VisaNet as a prominent payment system, they mentioned similar efforts bubbling up in places like the Gulf Cooperation Council, GCC countries, Southeast Asia, Africa. Sometimes these are even backed by government mandates to process transactions domestically first. And geopolitical stuff, sanctions, trade tensions, that's actually accelerating this trend as countries think more about bolstering their own sovereign payment capabilities.
Okay, data privacy and security, obviously massive global concerns. How do those specifically hit a company like Visa?
Well, you've got this explosion of data privacy laws everywhere. GDPR in Europe, various state laws piling up in the US, China's PIPL, India's PDPA. The list goes on. It creates huge compliance challenges.
Yeah, so.
These laws impact everything, how they collect data, how they store it, how they transfer it, especially across borders, which is fundamental to their business and how they use it. Compliance is expensive, and the potential fines for getting it wrong are massive. The report notes this complexity is only increasing as they develop new products, especially using data for things like AI, which requires really careful governance.
What about pressure from the other side? From the merchants actually accepting the cards?
That's another persistent challenge. Merchants and the companies that process payments for them are constantly pushing back. They lobby governments, they file lawsuits, they push for regulations, all aimed at lowering the cost of accepting card payments.
How does that manifest?
Sometimes they try to steer customers towards cheaper payment methods, maybe offering a discount for cash or debit, or they might add surcharges for using credit cards. It's this ongoing battle that puts pressure on Visa's revenue rates and, potentially, their relationships with crucial merchant partners.
Visa obviously doesn't do everything themselves. They rely on this huge network of banks, merchants, and now all these fintechs. Is that reliance itself a risk?
It definitely is, and they highlight it. They're heavily dependent on these third-party partners. If one of their key bank partners or a major processor or even a fintech partner has an operational failure or suffers a big cybersecurity breach or fails to comply with regulations themselves,
It splashes back onto Visa.
exactly. It can negatively impact Visa's business, their service levels, their reputation. They talk about having risk management frameworks, doing due diligence, having audit rights. But they also acknowledge that these might not catch or prevent every single issue with every single partner in such a vast network.
And their growth strategy involves buying companies like Pismo. Do those acquisitions come with their own set of risks?
They do. Acquisitions are part of the strategy, but they carry inherent risks. Integrating the acquired company's tech and people can be difficult, maybe cost more or take longer than expected. Sometimes the hoped-for benefits just don't materialize. And there's always the risk of inheriting unforeseen operational problems or cybersecurity vulnerabilities from the acquired company.
What about just finding and keeping the right people, especially in tech?
That's in there too. They note the market for skilled talent, especially in areas like software engineering, data science, cybersecurity, is intensely competitive. Attracting and retaining the key people they need for innovation and secure operations is a constant challenge, particularly with, changing expectations around work post-pandemic.
Okay, and finally, litigation. It sounds like that's a constant shadow over the business.
Hmm.
What are the main legal fights they're dealing with?
Yeah, litigation risk is mentioned frequently and prominently. The biggest ones seem to be the long-running interchange multi-district litigation, or MDL, cases in the U.S. These are basically massive antitrust lawsuits brought by merchants challenging the whole system of interchange fees.
Class actions.
Includes huge class actions, but also significantly numerous individual lawsuits filed by large specific merchants who opted out of the class settlements. They also mention other legal issues related to things like the shift to EMV chip cards, an ongoing FTC inquiry about debit card routing rules under the Durbin Amendment, and some newer cases as well. It's a complex legal docket.
Is there a price tag attached to this already in their financials?
Yes, they disclose what's called a litigation accrual. That's money set aside on the balance sheet for expected future costs related to lawsuits, even if the outcome is uncertain. As of September 30, 2024, that accrual was about $1.54 billion.
Wow. And where is that mostly earmarked?
They state that the substantial majority of that $1.54 billion is specifically for potential settlements or judgments related to those individual merchant actions within the U.S. Interchange MDL. So it reflects a significant potential financial exposure, although they always add the caveat that the ultimate outcomes are uncertain.
They also briefly mention corporate responsibility and sustainability risks.
Just briefly, yeah. Basically noting that societal expectations and regulations are evolving around things like climate impact, how they manage their workforce, human capital, diversity, and inclusion. Meeting these expectations and potential new rules requires investment and carries its own set of compliance and reputational risks.
Okay, wow. That is definitely a lot to navigate. Let's try and pull these threads together then. If you had to summarize the key takeaways from digging into these Visa 10K excerpts, what would they be?
Well, I think you see a company that is, without question, a dominant force in global payments. Its core business continues to grow steadily, fueled by more people paying electronically and more cross-border activity.
And they're not resting on their laurels. They have this clear strategy to push hard beyond traditional consumer payments into these huge new flow opportunities, B2B, G2C, P2P, using their tech and partnering heavily with fintechs.
Absolutely. And financially, that strategy seems to be working, delivering strong revenue and profit growth. Plus, they're actively returning significant value to shareholders, both through massive share buybacks and those unique structural mechanisms managing legacy liabilities while effectively boosting EPS.
However, there's always a however, isn't there?
There always is. The report makes it incredibly clear they operate in a really volatile and challenging global environment. The regulatory pressure seems intense and growing, particularly from regions wanting more payment sovereignty and fostering local alternatives.
Plus the ongoing pushback from merchants on costs, the significant litigation risks still hanging over them.
Right. Add in the complexities of integrating acquisitions successfully, managing risks across that vast third-party network, and just the general operational challenges of running such a massive global infrastructure. It's not an easy position, despite the strength.
So it's really a picture of this giant, powerfully leveraging its existing strengths and infrastructure, while simultaneously having to constantly adapt and defend against a whole multitude of forces pushing for change in how money moves globally.
Yeah, what's fascinating is just the sheer scale of it all. The scale of their ambition to digitize pretty much the entire global economy, and the scale of the challenges coming from powerful governments and regional blocs pushing back or wanting things done differently.
Okay, so here's the final thought we want to leave you with to chew on. Given this rapid pace of technological change we see everywhere, combined with this increasing regulatory scrutiny and these growing regional payment initiatives popping up all over the world, how might the fundamental structure of global digital money movement, who the key players are, how it works, continue to shift in the years ahead?
And maybe more importantly, what does that potentially mean for you, the person who just wants to pay for things easily or get paid reliably?
A complex future ahead indeed.